all you're doing is giving investors back their own money and you're calling it income. Let's imagine an ETF we could create today. It's going to be ABC income strategy, and we're going to pay out 75% annualized income. We can do whatever we want, right? Like we could pay out whatever income that we want. But where's that income coming from?
If you sell a call and you own stocks, you are effectively turning your stocks into a bond, right? You're giving up that upside to generate some additional income. If you can offer people some type of way to participate while still having some downside mitigation that isn't tied to fixed income, which we know has been unreliable, that's really attractive to people.
Shawn and Eric, welcome to Excess Returns.
Thanks for having me.
Great to be here.
You are both at Liquid Strategies, a firm that is focused on delivering institutional quality investment solutions, particularly in option-based overlay strategies. I think as more and more option products come into the ETF space, especially those that are kind of focused on yield and protection, we thought it'd be a great opportunity to have you on to sort of talk about these strategies, kind of cut through some of the noise, maybe talk about good and bad option strategies, how investors should really be looking at these things, and the way that you guys actually construct strategies, because I think it's been, maybe over 12 years at this point that the firm has actually been running these investment strategies, not necessarily always through ETFs, but so you have a long history of running strategies through different market regimes. And so we just thought it'd be great to sort of have you on it and work through all this. The name of the firm is Liquid Strategies, but the website is lsfunds.com. I have that correct, right?
Yep.
All right. So lsfunds.com if you want to check out Liquid Strategies and what these guys are doing in terms of ETFs and funds. So where I thought we could just start is there's a lot of different option strategies that have come to the market, particularly over the last 5 years, let's say. And what we thought we would do is just maybe, hear from you about what the landscape looks like. If you could give us sort of an overview of these strategies and sort of like how the market has maybe changed a little bit and some innovations that have happened in this space.
So I started trading options back in 1997. And so it's just interesting to see kind of how the whole industry's evolved really. So starting in around 2000, I started working more directly with kind of advisors and end users of option strategies. And the resistance to anything options was palpable. And it's just amazing just how, particularly in the last probably 6 or 7 years, how suddenly not only have options become accessible, they've almost become like a mandatory part of investor portfolios. And I think a big part of that was driven, I think, really by two things. One is the kind of ultra low interest rate regime. Everyone was looking for ways to generate income, thus enter cover call writing strategies, which we'll get into a lot more in a minute. And then the other one was the whole structured product push. All these principal protected notes ended up kind of turning into, the buffered ETFs and the principal protected ETFs. But once again, it's just interesting how it's just suddenly 6 or 7 years ago, this market just really took off. And from my perspective, and Eric, you can kind of take off from this point, but where I see kind of like, I guess the main categories here are the yield seeking structures, particularly cover call writing, and then the principal protection hedged equity kind of structures that are out there. And I think both of them have grown equally, but I think really for different reasons.
And just to maybe add, where you ended with that, you talked about use cases, right? And I think that's been a big evolution in thinking, prior to kind of the latest genre or wave of product. I felt like people kind of got lost in the weeds, right? They felt like they needed to understand how options worked. And what's really been a big success, I think, for the industry and for, and in some ways it created some challenges too, is that many of the advisors and the users of these types of products or strategies, they don't know how options work at all, right? They just know what the benefits are. And really that's kind of how they've been investing in these products. And so again, that's created some challenges, which we'll talk about a little bit today.
Yeah. And I think what you guys are doing over at Liquid Strategies in terms of education and trying to be leading with that content is really important because it kind of helps investors and advisors sort of understand, I guess, the use cases the pluses and minuses of these things. I know one of the things you guys have written about is, some option strategies actually have some like flaws, possible risks. Maybe they're not built as well. And so I was just wondering, could you kind of talk through maybe what some of those things, those flaws might be that would be sort of important for investors to understand?
Yeah, and I think that's a good starting point to really just talk about kind of who we are and what we do. I mean, we set out from the very beginning to kind of achieve some of these same things: income generation, downside protection, but do them in a way that was really kind of non-traditional, but the way that we thought was a better way of doing it. And so now we kind of flip on the other side. So what are some of these flaws that are out there? So I think probably the biggest one is this whole idea of fully capping your upside to collect a little bit of premium. And if you just kind of look at it, the biggest, you zoom out as much as you can, you think about what's the biggest flaw of covered call writing is the asymmetric return profile. You get a little bit of return and a little bit of premium, but you get almost all the downside risk. That is just any sort of asymmetric return profile like that is extremely unattractive. You can flip that around and just be a plain old put seller and sell a put. So you collect a little bit of premium. That's all you can make, but you have a tremendous amount of risk. And so anything out there that has an asymmetric return profile, we've always just run away from. We just don't think that that's the way to do it. Now, there's still ways to generate income to kind of approach covered call writing, but take some of that asymmetry out of it. So I think that's one kind of big area. And then I think the other big area is this whole idea of kind of set it and forget it. Okay. So many of these products then have these defined outcomes. I mean, that's the big rage right now is defined outcome. Hey, I know point to point what I'm going to get. So here's the problem. If you have a principal protected structure that's 1 year point to point, and the market in month one goes down 30%, and you hold it for the 1 year, in all likelihood, the market's probably going to finish close to where it started. And that protection really did you no good other than kind of smoothed out the ride for you. But at the end of the day, it didn't put any money in your pocket. In fact, it actually cost you money to have that hedge. So we're very much of the mindset to, as market conditions change, if we have hedges, or if we sold call options that we think no longer offer an attractive risk reward profile, we're going to close those for our clients. We are not going to just sit there, put the blinders on and just watch these positions go from being profitable to worthless. So that's a big part of our kind of DNA.
On the covered call thing, I've always never liked the idea about how they're sold as like almost free money. It's like, well, if nothing happens, you sell this, you get the income, you still got your stock. Like it's like this happy world. And I think the reality of it is a little bit different than that.
So, yeah. So if you look over the long term, I mean, it is extremely difficult over the long term to have a covered call running program that actually increases your total return. You enter it knowing that you're basically going to bring down your total return. And the question is, well, what's the benefit to bringing down your total return? And the answer always is, well, it's income. You get income. Well, you can pay yourself income from your portfolio, right? So why not just be fully invested in the market, let that appreciate and pull out some of that appreciation as you need it. That's a much more efficient way to pay yourself income as opposed to capping your upside. And this chart that Eric just pulled up, really kind of shows the difference between just being in the market versus selling kind of at the money calls over the long term. It really does nothing but hold back your total returns. And that's why we don't like it. It's the asymmetry.
You bring up a really good point there where if you have a portfolio and let's say, of the S&P 500 or large cap stocks, and you wanted to turn it into an income stream as opposed to just a capital appreciation stream, if you monetize that or sell it over time, you're likely going to get long-term capital gains, right? And so a lot of these strategies that are doing either covered calls or some type of option income configuration, they're typically going to be paying you, ordinary income, right? So you're not only getting that double whammy of lower long-term expected returns, but the tax treatment of those returns and that income is going to be detrimental to the end investor.
Yeah, and you think particularly in the environment we've been in, where the market's been running a lot, writing calls is not what you wanted to be doing over the past however many years. Like that hasn't worked out very well, I would assume, for people who've been doing it.
The whole idea of selling options is actually very appealing. And so we focus more on selling downside put spreads, which we'll talk about in a minute. But the question then becomes like, well, does it ever make sense to kind of sell away upside? And my answer is possibly, yeah, it can be. So let's go back to the flaws of cover call. And there's two major flaws. One, you're fully giving up upside above a certain point. That's flaw number one. Flaw number two is you have little to no downside protection. So the way that we solve that in the strategies that we run that are, cover call writing strategies, we do two things to solve those problems. First, solving the upside problem. For every one call we sell, we also buy one to basically protect us against that sharp move higher in the market. So we'll still get paid if the market's flat or up a little bit, but we're protected against a runaway move in the market. So it's so interesting when I talk to advisors and I talk about risk, the conversation's always about drawdown, drawdown, drawdown. But the risk of cover call writing is not only drawdown, but I think the worst risk is the upside appreciation loss because you can't get that back, right? So if you cap your upside and the market goes up 10, 15%, you can't just wait and get that back. Where if the market fell 15%, who knows how long you may need to wait, but eventually that asset will come back for you. But there's no sitting and waiting to get appreciation back. So having a significant amount of appreciation loss is a major, major risk. And the way we address that is, once again, buying a call for every one that we sell. And then on the downside, we take a little bit of that premium that we collect to actually give our clients downside buffers. So when we're generating income for clients through selling calls, we're buying a call to solve that upside problem, and we're buying downside buffers to solve the downside program. And there's actually an index that you can look historically that shows the benefit of this versus other call writing strategies called the Mercu Hedge Premium Income Index. And if you compare that to like the BXM or some of these major call writing strategies that are out there, it's a significant difference, both in terms of upside and downside. So here's the long-term chart versus the buy right index. Significant difference in long-term returns, but also look at some of the drawdown differences. Look at the magnitude of that drawdown in 2020 versus some of these other periods. And that's simply taking some of that call premium, buying a call, and buying a downside buffer. That's the only difference. But it's little things like that that no one else is thinking about or doing that are things that we're trying to focus on giving investors better outcomes.
And there's always a trade-off, right? And I think that's an important consideration with anything in investing, but especially with options, is that if you are going to be selling or buying an option, you have to really know what happens in the extreme scenario, right? So, if you sell a call and you own stocks, you are effectively turning your stocks into a bond, right? You're giving up that upside to generate some additional income. But why do we own stocks to begin with? Well, we own them for capital appreciation primarily, right? And then on the other hand, like Shawn mentioned, if the main weakness of owning stocks is that they can go down occasionally and go down very sharply, how do you mitigate that type of risk? And how do you do so in a way where you can still have the benefits of some participation of the upside, some income, and get that hedging?
Yeah, I thought your point about extreme scenarios is important because it seems like, at least to someone like me who's outside the options world, that we're seeing more extreme scenarios these days. COVID, what we saw earlier this year, it seems like everything is faster, everything is bigger now than it used to be.
And here's the thing about extreme moves. And, if you just went to sleep for a full year and during COVID, you think, wow, what a great year. You would have missed, the cards. But also those extreme moves create a lot of opportunities for people like us who are active, where you bought a hedge and it works. It's an opportunity for you. Or you sold call option, the market falls and that's worthless now. Well, what if you bought it back and then the market moves higher, which has been happening? So to me, I love these moves because one, we've got the right structures for them. But then secondly, there's some real benefits to these moves for our investors.
Just going back to your point about risk, I feel like, risk is, the more painful the risk is to you, the more you see it. And so that whole idea of covered calls, like a lot of people miss that risk just because their portfolio is not getting killed. They don't realize. So I feel like that's a big thing investors get wrong about risk, is you miss that upside risk because of that.
Bingo. Yeah. And they may be frustrated that their portfolio is not growing as much, but that's a big difference between getting poor. They're just not getting richer, but they're not getting poor. And that is a major distinction. And that's frankly something a lot of these funds kind of rely on, is that a lot of investors aren't really paying attention to what's happening.
So before we go any further, can you guys explain the concept of an overlay strategy?
Yeah. So, and goes back to the inception of the firm. So the whole reason we started the firm was really to take an investor's existing portfolio, regardless of what's in there. We're just being agnostic to what's in there, but take that and create some efficiency and generate extra income right on top of those existing assets. So think about the benefits of doing this. One, if you can actually generate positive return with this option overlay that's sitting on top of that client's accounts, you can increase the total return of that account. And you're doing so in a way that you don't have to make changes to the existing portfolio, right? Because we're just putting it right on top of an existing client's whatever assets they have. But what ended up happening is, as we moved into 2018, 2019, a lot of advisors wanted to access this overlay, but didn't have accounts big enough necessarily to be able to do it in separate accounts, which we have been doing historically, which is why we created our ETF suite to be able to allow advisors to say, hey, look, I want large cap beta with this overlay. I want small cap. I want core bonds. So now our investors have the opportunity to just pick their beta, but still get the overlay and do it in a turnkey solution.
Yeah. And one of the things that, I've heard people compare this to is capital efficiency, right? And so I know in listening to some of the guests you've had on in the past and just talking to investors that are kind of thinking more progressively about portfolio construction, people are always looking for ways to add additional return or leverage or, return stacking, right? And I think by using these overlay concepts and having structured risk profiles, that's super important for us, right? Because oftentimes direct leverage, you're going to have, some type of amplification in up markets, but you're going to have amplification in down markets equally as bad, right? And that's going to ultimately kill the strategy. Everything we do, we really think about reward to risk and structuring the position in a way where we know where our max losses are at all times. And we know that historically, when running an overlay like this, especially when selling optionality, you're going to be a winner most of the time. But it's in those rare instances where you lose that if you lose in a catastrophic manner, it totally kills the benefits of the strategy. Hence why we use spreads, right? So I know Shawn will talk about that a little bit more here.
Yeah, and I think, before I get into the details of spreads, think about, kind of our goal is to just generate incremental return. And it doesn't have to be a lot. Even if we could generate 1% in incremental return on top of what a client's already getting, that's a huge improvement. Think about that over the long term, how much that can compound. If you get 2% extra, particularly if it sits on top of bonds, if you're expecting to get 5% in bonds and you get an extra 2% in this overlay, it's a real game changer. And I bring that up because in order to get 1% to 2% type of returns a year through an option writing strategy, you can be extremely conservative. And I think that that's where a lot of other managers have gone wrong. So we're not the only ones who have done or are doing overlays, but the big difference between us is we approach it we're just trying to hit singles for our clients. We're trying to just give them a little bit of extra return, where others are looking for that occasional triple home runs. But that's where you're going to have, if you're in a 2020 situation, 2018 scenario, where you're really putting your clients at risk. And so if you look at what we do, I think most people in our business would probably accuse us of being ultra conservative.
To your point though, Shawn, that 1% per year compounded over, a 20-year time period, that's a pretty big difference in terms of what the end portfolio value is, versus the original. So that's a very good point. I think investors kind of sort of lose sight of that. They may hear 1% and be like, oh, that's not a big deal, but it certainly is a big deal.
It is an absolute game changer. And I think most investors, or most advisors who are thinking 8 to 10% returns long term are fantastic. You can easily think, well, what's an extra, like, if I can grow that by 10% every year, like that's really, really meaningful.
So as we get into the actual strategy, I really like this concept you guys have of the Swiss Army knife, because we talked earlier, like a lot of these option strategies are meant for one specific purpose, and that's it. And it seems like you guys are trying to maybe accomplish a bunch of different purposes of the same thing. So can you talk about your strategy in light of this Swiss Army knife concept?
Yeah, so let's talk a little bit more about exactly what the overlay is, and then how it could be used as a little bit of a Swiss Army knife. So we sell below market put spreads on the S&P 500. So by selling a put spread, what that means is we sell a put where we basically take on someone else's risk. We simultaneously take a portion of that to limit our downside risk. So unlike a naked put where you just sell a put and you're taking all the risk below that level, we have a predefined, very small corridor of risk that we're taking from someone else, and we're getting paid a premium to do it. So now think about the different markets where we can have a positive outcome. If the market's up, regardless of how much it's up, that's going to be a successful strategy. And it's not doing anything to limit the appreciation of that underlying asset. It can just continue to appreciate without any limitations. If the market's flat, it's a win. Our clients are still going to get that income and be able to do it again and again. Even if the market's down slightly, so if we sell an option that's 1% below the market and it's 1.5 weeks in length, the market could fall 1.5% during the week, and we still capture that full premium. We got to realize the full premium. So we can actually make money up, flat, and slightly down market. The only time we lose money is when the market is down in a meaningful way. But what's great, we go into it knowing exactly kind of what's our worst case scenario. We know that at all times. So by doing that, we think we can generate net of fees over the long term, kind of in that 1% to 2% type of range. So now let's kind of bring it into the Swiss Army knife. Like, what does that do for a client potentially? And I think we're really in three things. I think one, if they just want to grow their assets more, they're kind of in their glide path where they're trying to retire, but they want to get that principal up. They want to grow it a little bit more. That can just go into the total return. You reinvest that, put it back in equities, you keep going, we write them, and you can just kind of keep compounding that premium that we're generating. So that's use case number one. Use case number two is somebody maybe who's already retired and they're looking to get as much income out of that portfolio as they can. But this, once again, as opposed to cover call rider or some of these other strategies, this income we generate is incremental. So it's not taking anything from their portfolio. This is income that's coming in above and beyond anything else that they're getting. So it can be an excellent source of income for clients that want it. And then lastly, if we do have investors who are concerned about downside risk and don't want to just write the check for the protection, they don't want to just buy insurance, this could be an interesting mechanism for them to use this premium to finance the purchase of downside protection over the long term. And they could do that either for a diversified equity portfolio, or they could do it if they have like a concentrated stock position. They can use this income. If we generate 2% a year, that's going to buy them a fair amount of downside protection. So you think about that, it's really could solve three problems: growth, income, and downside risk management, all through this one strategy, which is selling downside put spreads.
Can you talk about the importance of time frame? Because it seems like any strategy that's using options, it would be very important. What is the time frame of those options? And I think that's something where you guys do something a little bit different than other people do. So can you talk about that a little bit?
Yeah. So when you sell options, you typically want to do it on a shorter term basis. And the reason being, options are wasting assets. So they lose their value. So the market's just flat. Just imagine they lose their value slowly over time. But what happens, it's not linear. It actually accelerates as you get closer to expiration. So in that last couple of weeks, you can see here, not a lot of decay happening between 6 months out and a month out. But in that last month, that rate of decay just accelerates which means that option value really just falls off the cliff. So if we were to sell 6-month options, you're going to be doing a lot of waiting. And because you're doing a lot of waiting, you're not going to be able to harvest as much premium. By doing shorter dated, so we focus kind of 1 to 2 weeks out, we have the ability to harvest more premium over the time frame. So the natural question is like, well, what about with 0 DTE options or 1 DTA options? Why don't you just do that short if it's better to be shorter? And my answer to that is it's too much extreme path dependency. Like everything you're doing depends on what happens today, where for us, we basically we ladder our positions over multiple expirations and end up having usually multiple strike prices so that our path dependency is more diversified. So I'm not going to get up every morning like, please let the market be ABC. We're not worried about that at all because we have our positions kind of well diversified. So I think, Eric, you used the word earlier about balance in a portfolio. And I think the way that we approach it, we're thinking about balance. How can we balance the income generation, but also improving the path dependency of the strategy?
I think that's a really important point too. I mean, if you look at kind of what I call naive option selling products, which are your 1 month, at the money call, or, your 3 month or your 12 month, right? Once that trade is on, you're married to it. So if that doesn't go well for you, like Shawn said, you have a lot of path risk, right? Or path dependency risk. So the more you can ladder and diversify and kind of stagger those risk profiles, you're going to have a much smoother time, right? You won't wake up and have some type of catastrophic event that totally kills you for the, next couple of years. Or as I kind of put it, you don't have to worry about betting on the wrong horse, right? You're just basically betting on the entire, pool. And I think that provides a much smoother outcome for people. It's easier to manage, easier to sleep at night.
I'm just curious, since you brought it up as an aside, what's your view on 0 DTE? Like we talk about that a lot in our other episodes, the idea, like some people think it's going to destroy the market. It's a ticking time bomb. Other people think it's like a volatility reducing thing, or it's changed the nature of the options market. I mean, do you have views on general, like what the impact of that has been on what you do?
Yeah, I think the implication it could have is simply the possibility for more bigger 1 day moves. It doesn't really change the fabric of the market kind of over the long term, but it does increase the chance of a larger move in one direction. Or actually, I think the bigger probably thing is that you get moves in multiple directions within a single day. And it's because, not to get too option geeky, but because of the short gamma nature of these positions that dealers are taking on, market goes down, they have to sell more, which accelerates the downside. Market goes up, they have to buy more, which accelerates the upside. And you can see how that can have a yo-yo effect. But at the end of the day, it's not really changing the day-to-day, week-to-week, month-to-month volatility of the markets. It's just providing a lot of people opportunities to try to make money on a short-term basis. But it's, to me, once again, to try to, in this world, try to bet on what's going to happen today or just over the next day. How can you, when you don't know what news is going to come out today, what tweets are going to come out today? It's an impossible environment in my mind to be able to do that in any sort of systematic way.
How do rates and volatility impact what you guys are doing? Obviously, we're in a much higher rate environment than we were. I mean, volatility, right now it's pretty low, but we've seen still a bunch of spikes in it. How does that impact what you guys do?
Actually, very little. So as far as interest rates are concerned, we're fairly agnostic to what happens to interest rates. The only tie-in with interest rates with what we do is what impact do moving rates have on volatility in the markets and equity direction. That's the only impact, but it's not like rates go up and our option prices lose value. We don't have that sensitivity. It's more where our positions respond to changes in the equity markets, which could respond to some changes in the interest rate markets. But the correlation of our strategies to interest rate moves is very, very low. Now, volatility is a very interesting one because most option writing strategies say, hey, higher volatility is great because we're going to collect more time premium. We look at this totally differently. We want our odds of success in the program that we run to be consistent in all market environments, whether we're low volatility or high volatility. And the way that manifests itself in volatility changes, that level that we sell the puts adjusts to market volatility. So as market volatility goes up, the puts we sell automatically, this isn't a decision that we make, it's just mathematically shift further below the market, which gives us a bigger cushion to the downside, which you want during times of stress. So rather than us taking more premium in when volatility goes higher, we'd rather give ourselves more room to the downside for protection, given our conservative approach. So at the end of the day, our premium differential doesn't really change that much to changes in volatility, but where our risk begins is significantly different. So then we do that through what's called delta targeting. And there's not very many shops out there that approach this that way. Most of them do it. We're just going to always do blank. We're going to sell one that's 1% below the market, 2% below the market, but 1% below the market when the VIX is 13 is very different from 1% below the market when the VIX is 50. So we'd rather have that out of the money amount float with volatility.
It does seem like this is an area where, they always talk about simple is better than complex in investing, but it seems like this is an area where maybe it's reversed to some degree, because you have a lot of these option strategies that do a very simple thing, like you mentioned, just over and over and over again. And probably having some context and some understanding of what you're doing is better than just these repetitive, simple processes.
But we actually strike a nice balance, because it is repetitive what we do. It's just different. So rather than selling the 1%, we sell the 70% probability option. But it's the same idea where we just repeat, do the same thing. But it's just that we're thinking about it differently than most people are doing out there. And we also don't. So this put that we sell, if I sell this option, I collect 1% in premium today, and market goes up over the next 2 days and volatility goes down, and that's suddenly only worth 5 basis points. And I originally got 100 basis points, and there's a week and a half left to expiration. That's a horrible risk reward profile for our investors. So in all likelihood, in a scenario like that, we would go in and close that position. So that's where I think that's where the biggest difference comes in, is we do have a systematic approach really on putting positions on, but we're very proactive in how we think about taking them off.
And I think that's really important, right? Because there are these opportunities occasionally where you can reduce risk, or you can harvest, and always thinking about what is the most you can make on a trade, right? When you're short volatility, that number is defined, right? It's capped. But you also, if you're not covered, you can have extreme losses, right? And in the case for us, we say, if we are going to open a short position where we know what type of return profile we can expect, we also know how much we can lose, we're much more likely to just say, hey, when we have, one of these early winners like Shawn described, let's take the risk off the table, because what's, the best that can happen here, we gain another 5 basis points. That's not worth losing, 100, 200, 300, right? Same thing on the other side of the ball. If you're ever buying optionality, you're buying hedges, you're going to have some type of fixed budget for doing so, but you need to have a way to get out of the trade, right? And so earlier, Shawn alluded to strategies that are passive in their downside protection, going through a down market, holding a hedge, coming back through the other side and having nothing to show for it. If you have a process or a system in place, and almost looking at, again, what is the best that can happen? What's the worst that can happen? Once you get near that best possible outcome, you need to have a plan for taking risk off the table or realizing, your returns in that moment.
Yeah, it seems like, it's funny in my world of like picking stocks, like there's this, everybody have this vision of like this great stock picker who's like this discretionary person who just outperforms the market all the time. And like, that's usually not the reality, which is why we use a systematic approach. It seems like it's the same with what you guys are doing. Like, the people probably have the vision of the discretionary options person saying like, oh, I'm going to do this, that, and the other thing, but probably having a systematic, repeatable approach is probably a big advantage over that.
Oh, way better. You do not. So I think what you really, really want is you want a portfolio management team that has disciplined guardrails, a disciplined process, but that can provide like kind of a discretionary overlay from a risk management perspective to make some adjustments around the fringes that adjustment doesn't cost much to do, but can have an outsized impact. But over the long term, even if those changes don't do anything to add value, they still make a lot of sense to do, because all it takes is one of those times where you closed a position for 5 basis points and you saved your investors 300 basis points for it to all pay off, for multiple years to come. So I think you want to balance. I do think for all of these strategies, you want a disciplined process with guardrails. I think that that's critical. You don't want someone who could just do whatever they want anytime they want.
And on that point too, I mean, going back to covered calls for a moment, and I just pulled this chart up kind of on the fly. Think about during this year, right? Liberation Day, when the equity markets fell, and whether you were in stocks or in a covered call strategy, you're going to feel that drawdown, right? In such an environment, it would have made a lot of sense to buy back a call after it's now moving further out of the money, right? But a lot of these strategies, they'll end up just basically holding that position. And then if the market turns around and rallies, and we know markets tend to rally the hardest off of a bottom, having that upside cap preserved is senseless, right? So that's another thing to think about too. And going back to the covered call concept, the naive strategies are always going to sell programmatically, right? They're going to keep that figure there. They're never going to buy it back. But occasionally you get as close to a free lunch as you can in markets, and having that active little touch over top can make all the difference.
Can you talk about, you see a lot of high yield strategies. I mean, it's not just in options these days. I mean, you see crypto stuff paying high yields. I mean, I saw some ETFs the other day. I think there's some that just give you your money back and they call that like a high yield. But like, what are some of the things to keep an eye out for? Because you'll see a lot of option strategies that will claim they have a very, very high yield. So from you guys inside of this, like, what are some things investors should look out for when they see these strategies that have these really high yields?
No, Jack, you just really hit my hot button here. So, okay, let's imagine an ETF we could create today. It's going to be ABC income strategy, and we're going to pay out 75% annualized income. We can do whatever we want, right? Like we could pay out whatever income that we want. But where's that income coming from? Is this actual income, or are you just giving investors their money back? So you and I can just create something tomorrow and give investors whatever part of their money back you want to give them, 10% a year, 20% a year. And that's effectively what's happening in the market. Although it's not that discrete, it's being done through call writing, but it's the same thing, where all you're doing is giving investors back their own money and you're calling it income. And so I think there needs to be some more visibility into what is this income? How is it different between this fund and this fund? And I think we have a lot of work to do there, because I'll tell you, the income that we pay. So people will look at some of our strategies and say, 5% yield compared to 20%, that's not very high. Well, what's the total return of the fund that's paying 20%? What's the volatility? You start digging into it, and you just start to realize, you have one strategy that's generating alpha and generating outperformance. And then you have other strategies that are just giving investors their money back. But it's so easy to talk about as an advisor to clients. It's so easy to say, hey, I've got this great income strategy that's going to pay you 20% a year. I'm going to put 10% of your portfolio in it, and clients be all over it. But the reality is they don't fully understand what that 20% really, really is and the impact it's going to have on that portfolio. You don't want them to pull out 20% of their portfolio. It's like you want that to stay in there and to be reinvested. Who wants 20% income? Because it's not 20% above. You don't put $1 million in and every year you get $20,000 or $200,000. That's not what it is. So you don't want investors pulling that much of their portfolio out anyway. You want it to reinvest in common. So, sorry to get on my soapbox there.
No, I mean, I think there's a few things here. One is that a lot of people, one of the first things you learn about in investing is dividend yields and kind of compounding dividends, right? And so I think that carries over for a lot of people. They see a yield and they expect that to be a total return or some indication of long-term return, which we know is not the case. In a fund, which is not a stock, right? A dividend yield is mainly a policy choice or forcing income if it has to come out from a tax perspective, right? So a lot of providers will choose the policy choice angle because it looks good from a marketing perspective. But going back to what Shawn was talking about, right, is the total return of the fund. So the price and the distributions combined in a stream, that's what you really need to pay attention to. And unfortunately, a lot of the default charting and data tools that are available to investors, whether it's, Google Stocks, Yahoo, et cetera, you're seeing the price return, right? So you're not seeing, the true total return of the investment. I think for people watching, if they're really thinking about these types of investments and trying to have a better idea of how they're performing, look at different charting tools like Koifin is a good one that's free, and some others out there. But just always thinking about investing on a total return basis rather than just the dividend or just the yield or just the price. Super important.
And a good example of what we're talking about is, Eric, you had the chart of the BXM year to date that's effectively flat. But if you look at the option premium, the income that index is probably generated year to date, it's probably close to 15 to 20% so far year to date. So that's your income. But if you actually paid out that income to investors, you'd only have, let's say it's 15%, you'd only have 85% still invested, 85 cents on the dollar still invested in that strategy. You still have $100 total. You just gave 15 to the investor. Now you only have 85 in there. It's not like it's still 100 and you already paid someone 15. And so that's a good example. The total return is BXM right now. You could have paid a lot of income, but you've made nothing total return.
It's funny. This has been like a timeless principle of investing. Like in my world, Eric, you cited it. Like in my world of dividend paying stocks, like the stock with the 12% yield is the stock you want to stay away from most of the time. But people see the yield because obviously there's massive problems with the business, something going horribly wrong. Like nobody sustains a 12% yield. But like people want to flock to those stocks. So I guess it's no matter what types of strategies are out there, it's kind of a timeless thing.
I do think there's enough advisors, thankfully, that understand that if something seems to be too much of a good thing, it probably is. So, I think a lot of advisors kind of catching on to like, all right, something's off here. There's no way two funds that kind of look exactly like, one can pay 9%, one can pay 30%. So I'm really hopeful and optimistic that there's so many good advisors out there who can sift through this stuff and really be able to differentiate between the different approaches out there.
The other main thing we talked about options besides income was hedging and risk management. So how do you guys think about your strategies from that perspective?
So this ties back to the whole conversation around cover calls. So there's a very common phrase out there called zero cost collars. It is the oldest time-tested way of hedging, whether it's a concentrated position or an equity portfolio. And all it is you sell that cover call that we've been talking about, but rather than using that as income, you use it to purchase downside protection. So you put a collar on whatever asset is that you're trying to hedge. So you know what the maximum value is and you know what the minimum value is. And the reason people do that, they don't want to just buy that downside protection. They'll write checks for car insurance, home insurance, health insurance, life insurance. But the biggest asset that they have, their investment portfolio, more often than not, they don't want to write a check to protect that. But they're very willing to give up significant appreciation to pay for it. So we're big believers that the cost of that appreciation, giving that appreciation up, is significantly higher than the cost of just writing the check for that portfolio. So for that protection. So our hedges, the way we approach it is we just simply buy that downside protection and we try to do it in as cost-effective manner as possible. But we want our clients to have as much of that upside potential as possible. So when we run our hedged equity strategy, we do not cap the upside. I'm not aware of any other funds or strategies that are out there that do it that way because everyone's been trained to finance downside protection by selling away upside. And I don't think it's the right approach. So that's differentiation number one. Differentiation number two that we've talked about is, well, we have these hedges in place. We don't just like buy them and just forget about them. As the market starts to move down and that protection's really working, we'll monetize that protection. No, we won't get rid of it. Our clients will still be protected. But what we'll do is we'll take that floor that's up here and we'll just move it down. So by moving it down, we can pull out some of that value of those options that we can then return to our investors, but still have that downside protection. So that not only puts money in their pocket today, but also better positions them to participate if there is a bounce back in the market. So we're very, very proactive in monetizing successful hedges. And also, if we put a hedge that's down here and the market goes up, if we don't do anything like most funds out there do, you have that air pocket where all of a sudden that hedge that was 10% below the market is 20% below the market, 30. That hedge is no longer going to be any value to you at all. So we, as the market moves up, we anchor those hedges to the movements in the market. So almost kind of think of it like as a floating stop loss. Market goes up, we're moving that up so that the client's able to lock in some of those unrealized gains. And so market goes up, we're moving our floor up with it. Market comes down, we're extracting some of the value of the hedges and moving it back down. So that's how we approach it.
Eric, I know you talk to advisors a lot. How do advisors think about like people who have 60-40 portfolios or something like that? How do they think about incorporating something like this in?
I think that, going back to the challenges that fixed income has, served people over the last couple of years, and really like predating the fixed income volatility of 2022 and higher rates, even just having lower return expectations in your bond allocation has forced people to do different things, right? And so hedged equity strategies or structured products, defined outcome products, et cetera, those have become very popular because most people, when they pay attention to the markets, they're paying attention to their stocks anyway, right? So they have this kind of expectation alignment with, whatever the stock market's doing, I want to be kind of near that, right? So if you can offer people some type of way to participate while still having some downside mitigation that isn't tied to fixed income, which we know has been unreliable, that's really attractive to people. But where you see people kind of getting into trouble is they find something like a costless collar strategy and they think, oh man, I found this, holy grail, right? This perfect thing. And they end up replacing too much of their equity with that. And then they run into the issue of losing out on long-term compounding because they're capping their upside, right? So, we see kind of the most healthy approach. If you have a traditional asset allocation portfolio of stocks and bonds, if you kind of carve something out of the middle, right? So say from a 60-40 to a 50-30-20, and you use that kind of new 20 bucket as, something that can have defined outcome or hedged equity or, just other types of diversifying strategies in there, that tends to be a really good way to put it all together without losing the bulk of that equity upside.
I wanted to ask you guys, you have your ETF suite and there's a number of ETF products in there, but then there's these interval mutual funds. Could you explain like what the difference is there, and then how investors, like what considerations would go into the difference between investing in the ETFs versus the interval funds?
So, really the reason for having an interval fund structure is to have basically semi-liquid investments, right? So the only reason you would want to put something into an interval fund is to kind of keep those assets, invested on a longer term basis than something that might trade on exchange on a day-to-day basis, right? So, if you think about the private markets, right? Private credit, private equity, those are typically going to be the types of strategies you see in interval funds. And so for us, we really saw this opportunity in the direct lending and private credit space, primarily as it pertains to kind of the less, the less loved or the smaller areas of the market that aren't seeing as much competition for deals right now. And thinking about this, structural tailwind of companies and businesses that need financing but can't get it from a bank and are maybe too small or, not the right profile to go into the public debt markets. And there's a lot of these businesses, right? Especially after 2008. And so we've really designed the interval funds, one, focused on investing and providing access to those types of investments for our clients. And, in one of them, it's just a private credit fund effectively, right? Kind of small to mid-sized private credit where we look at these inefficient opportunities and hopefully can provide higher yields and potentially more stability for our end investors. But what really kind of tying it back to the option component of the conversation, what we really saw as a unique opportunity is to take this different return stream of, credit-based assets that generally tend to produce higher yields to investors, and then using that to fund optionality on the market, right? So in the other fund, we really just take that income and then we use it to purchase S&P 500 call spreads that can give our investors some degree of upside participation in the market while limiting the amount of downside exposure they have to equity markets as well. And we will roll that position on a quarterly basis so that you have a lock-in or kind of a step up.
So if you think about this private income that we're generating, there's really a couple interesting things you can do with it. One, you can pay it out to investors as income, an excellent source of kind of above average cash flow. The other thing you can use it for is to buy upside potential in the equity markets. Now, there's plenty of strategies out there that are doing this, these buffered products, these principal protected defined outcome, where you have full principal protection and a certain amount of income for a full year. But the way this works is the amount of options you're able to buy is predicated on the amount of income that you're able to generate. So if your underlying assets can generate more income, you can buy more options, which gives you more upside potential. So if you look at most products that are out there, they're working at off of more like kind of 4.5%, 5% type of interest. Think about like a 1-year risk-free rate is kind of what they're working off of. And so they are able to go out and buy as much optionality as they can with that amount of capital. Well, if you're in private credit and let's say net income that we could generate is hypothetically 10%, you now have twice as much income than another solution does to buy upside potential in the market, which gives you the ability to have significantly more. So the way that we think about it is, one, we don't like doing anything a year at a time. Going back to path dependency, there's so much that can happen in a year. We like shorter time frames where we can take advantage of movements in the market and kind of give our clients what we think is a better long-term outcome over shorter kind of periods of time. But if you look over kind of a full year cycle, we're targeting more like 15 to 20% in upside potential versus most of these strategies out there are like 6 to 8% potential. And that's all tied to the fact that we generate more income to be able to buy that upside optionality. And this may going back to just compounding returns and over the long term, the difference between being able to make 7% a year and 20% of the year, it's game changing. If the market's up 20% and you only made 7%, that 13% loss that you miss out on, you're just not getting that back. And so we really want to do this in a way that you can get as much of that 20% as you can.
I'm not trying to make you guys market timers or forecasters here, but is there anything, because on the ETF suite, you have your US equity with large and small caps, foreign equity, you have the hedged large cap equity, and then you have the core bond, short-term bonds, and municipal bonds. So it's a nice suite, diversified suite. Is there anything that you're seeing within these that looks just interesting to you from an asset class perspective? Like I'm just thinking like this year is a pretty good, I haven't looked at the performance, but like international stocks are, finally outperforming. Do you guys think about that type of stuff? And what are you seeing that's unique here?
Yeah. So here's what I like. And it actually goes back to a comment that Eric made. So if you think about why investors are using hedged equity, a lot of them are doing it because they can't count on their bond portfolios anymore because of the interest rate risk, right? They used to be the ballast of the portfolio, but what if they're not anymore? And so they're concerned about the duration risk of that part of their portfolio. So one I think very interesting thing that we offer is the overlay that sits on top of short duration bonds. So you can take a lot of that risk out of the interest rate potential moves using a shorter duration as opposed to an ag approach. And any income that you might be missing, which actually is not that much based on where the yield curve is, but to be able to supplement that income with what you can get from the overlay makes that a really attractive way to generate really above average income, kind of the income probably at or higher income than you can see in high yield right now, but do it without the credit risk and do it with way less sensitivity to interest rates. So I think that's probably the one strategy that we have that's kind of flying under the radar just a little bit. Because when I think of like the foreign stock, kind of rotation into foreign stock, who knows if that's going to last, right? And that could be a short-term anomaly. Maybe it sticks, maybe it doesn't. But I think the bigger thing that investors are thinking of is what's the ballast of my portfolio? I don't think most advisors out there, I don't think are thinking like, how do I get more and more? They're more thinking about like, well, what if? Like, what if we get into stagflation? What if we do that? They're thinking of the risks. And so I love hedge equity as a solution for that problem. But also, if you need the income and you still want to be in bonds, I think being in a short-term bond plus the overlay, I think that's a great way.
Yeah, and I'll just add, our specialty is options, right? So we built these strategies to give people building blocks effectively and let them express their own views. But what we do know for certain is that a put spread overlay, if managed correctly, has a high probability win rate. So whatever your view is on the market, we think it makes sense to potentially include something like that over top of any piece of the portfolio or the entire portfolio if it suits your needs.
And also coming back to, we talked very briefly about that hedged premium income concept. So the idea where you can sell cover calls, but not give away all the upside and have downside protection is really interesting with that whole theme too, about how do I have a ballast in the portfolio that's not sensitive to interest rate? That could be interesting too, because it is an income focused strategy with downside protection. So we actually have really three different things in my mind. You think about short duration plus the overlay, hedged equity, and this hedged premium income strategy. All three of those could kind of fit that bill in terms of serving as the ballast for those who just really are a little skeptical that bonds are going to play that role.
This has been great, guys. Thanks for spending a Friday afternoon in August talking options and talking shop with us. We really appreciate it, and I know our audience will too. Just in closing, and Eric, I know you know this is coming, but and you guys can both take a shot at this, but we like to ask sort of a standard closing question, which is based on your experience in the markets. If you could teach one lesson to your average investor, what would that be?
It's kind of the lesson I tell my kids is start as early as you can, invest as much as you can, as early as you can, and stay in the market. Time is on your side and you need to be in the market. Now, the trickier part is staying in the market, particularly as you accumulate wealth. How does somebody with a significant amount of wealth, as they're going into a bear market, keep themselves from making emotional decisions? And I think that's where some of the tools that we've talked about can come into play to really help keep them invested. I think the biggest mistake an investor can ever make is to come out of the market right in the eye of the storm, right when the market looks its absolute worst. And we all know that. And I think most investors know that. But the only way to really, suppress that urge to do that is just to have the right tools in your portfolio.
And just to riff on that, most of the risk assets we're invested in, I mean, almost all of them are short volatility, right? So you're expecting them to do well most of the time. You're hoping that the world doesn't throw a curveball your way, but we know that it does. Right? And so back to the, conversation earlier about you insuring your home, your car, maybe your life, rarely insuring your portfolio or protecting your portfolio, having, most of your assets in shortfall, and then being really intelligent or working with people who can help you with a little bit of long volatility to help kind of balance that out. Not only is that going to help you perform better in down markets and long term, but it helps you sleep better at night too.
Great. Thank you very much, guys. We appreciate it.
Thanks for our bunch.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.
The views expressed in this podcast are for informational and educational purposes only and should not be construed as investment advice or a recommendation to buy or sell any security. Past performance is not indicative of future results, and all investments involve risk, including the possible loss of principal. Any references to returns, yields, income, or performance are provided for illustrative purposes only, may be hypothetical in nature, and are not guarantees of future results. Actual results may differ materially. Indexes mentioned are unmanaged and cannot be invested in directly. The hosts and guests may discuss strategies or products managed by Liquid Strategies. These discussions are intended to provide general information about investment approaches and should not be relied upon as the sole basis for making investment decisions. Please consult your financial advisor to determine whether any investment strategy is appropriate for your individual circumstances. Any favorable statements made by podcast hosts about Liquid Strategies or its affiliates should not be construed as endorsements. No compensation was provided for such statements. Options trading involves significant risk and is not suitable for all investors. Options can be highly volatile, may lower total returns, and even well-structured strategies may result in losses due to market conditions or unforeseen events. Before engaging in options trading, investors should carefully review and understand the disclosure document, Characteristics and Risks of Standardized Options, available at www.theocc.com. For more information, including a discussion of risks and disclosures, please visit lsfunds.com.